Good morning, good afternoon, good evening. It's November 3rd, Friday, 7:34 p.m. And this is our latest episode. Again, this is Mark Yu,
And this is Wawi Santos.
and this is the Mark Yu and Wawi show. So just for disclosure, this is not we are not registered financial advisors, but we are passionate investors in the stock market. And weekly we try to do a recording and review the overall um, you know overview of the markets and how it's responding to the current events. And on this week we have the latest episode 87, Bulls Roar. So for those who are following us, just a couple of weeks ago, we have bears in the background. But right now, we just had our best week this year, November, coming into November. So we're gonna dissect what has transpired in the past couple of days. So let's go ahead and take a weekly review of the investor sentiment before anything else. So this is American Institute of Individual Investors. So believe it or not, despite having the best week this year, a lot of investors just a couple of days ago, November 1st, are in the bearish camp. Half
Mm-hmm.
of those who were surveyed were in the red, like thinking that the stock market will actually go down. So this is quite a little bit of painful for those who were actually putting their money into work. Imagine if you based your investment for the short term shorting the market. But beside that, in contrary to that, what had happened for the past couple of days is surged, as we're going to take a look in a little bit. So a lot of bearish sentiments coming into the last couple of days of this week, especially when the jobs report came out this morning, right, Wawi?
We have a slowdown
Yeah,
on the employment side and better than expected job increase. I mean job job loss.
job loss. Yeah.
So
So that's weird because, like what we just said, the U.S. economy, according to Trading Economics, added just 150,000 jobs last month. This is about half of a downwardly revised 297 jobs just a month ago, and below market forecast of 180,000. So we're $30,000. I mean, $30,000, 30,000 jobs short. Plus, it's like half of what we have gained just a month prior. And if you're gonna look at the chart, it's quite a dip. It's quite a dip from September. But we also had a weak performance back in what is this? Back in June. So I don't know, maybe seasonal.
well,
But
they're
mhm,
thinking it's because of the UAW strikes that just happened last
exactly.
month that put a dent on those uh, jobs numbers.
Right.
So we'll see what happens next month
Mm,
if that's the trend. But that boosted the market today after they saw the news, and yesterday it boosted the market, made
mhm,
it more bullish because of the yields on the
mhm.
10-year going down again.
Right. So if if yields are going down, actually, based on a Bloomberg article that we're going to show in a little bit, everything rallied, including the yields. So if yields go down, bond prices go up. It's like
Yes.
a inverse proportion. So actually, investors were buying bonds too. Um, so yeah, going back to this jobs report, you could tell it says that job gains occurred primarily in healthcare, ambulatory healthcare, and hospitals, and followed by government. which has returned on the government aspect of things to its pre-pandemic February 2020 level, which is good, which is a good sign. So, but right now it's still bad news, actually. Bad news is still good for the market. So when is it gonna flip? I don't know when, but look at the unemployment too. For October, it rose to 3.9%, exceeding expectation of 3.8. So not a whole lot of difference, but we are actually on a high, at least
Mm-hmm.
since the start of the year. So it's been trending up. So this is the highest jobless rate since January of 2022. It's been more than a year. So a little bit troubling if you're not optimistic in terms of fundamentals in the market, because otherwise the stock market is reacting that okay, the Fed won't be raising rates anymore, so money would be easy again. So a little bit less tightening. It means money will be a little bit free flowing moving forward. So for the fear and greed index, as of today, it's at 42, which is fear. A week ago, it was at 27, a lot worse. Wow, would you look at that? The market momentum that me and Wawi are tracking on this show.
Ooh, look at that spike.
Yo, we're back on the 125-day moving average, back at it again. So that's a crazy bump right there. So from
Mm-hmm.
October 27, we were at 4,100. This is when we did our previous recording, when we have the bears on our background. But we have recovered all that loss and then some more back to the average the past 4 months. That's incredible market momentum right there. If anything, we actually did that on October 9th and October 16th. It kind of hovered there from October 9th to 16 for a week, and then it collapsed to the downside. So will this hold? I don't know. Future will tell us. But this
Well,
is
the futures are high too. Futures are up as well when the
okay.
market ended.
That's good.
So, so somewhat of a bullish trend right now.
Yeah. But that's a good erasure of losses right there. So for those who have given up, it might be hard to buy the dip at this point because we're already back at the average. Look at that, just for 1 week, not even about a week. The S&P 500 regained all the losses it made. So let's see the put and call options. A lot of people are still buying put options, you could tell. So a lot of bearishness. The volatility, it pierced through its 50-day moving average. So it suffered a major dip from nearly 20 points. It's down to 14.9 points. So as a market reaction, just today, volatility is down 5%. Past 5 days, it's down 28%. The volatility. For the
Mm.
NASDAQ, today's almost the same. Yeah, almost the same as the volatility itself. So S&P 500, it's up 5%. It just had the best week this this week that just ended. So look at that. Bloomberg came out with a timely article saying biggest cross-asset rally this year takes Wall Street by storm. Traders were piling into short stocks, bond bets before rally. A lot of traders got screwed over
Mm.
for the past couple of days. Stocks, bonds, and credit notched concerted gains this week. So this was just published 3:30 this afternoon. Evidence that Chairman Federal Reserve Jerome Powell is turning less hawkish fueled the biggest concern melt-up since November 2022. Stocks, bonds, and credit rising in tandem, according to Bloomberg compiled data. The consensus had moved to a soft landing, rate pause, Goldilocks, according to Luke Hickmore, investor in Aberdeen Investment. There are signs of short covering everywhere.
Oh my, ouch.
Yes. So if we're gonna take a look at this chart provided by no other than Bloomberg, each and every asset, SPY, LQD, TLT, HYG, everybody is in the green. And you didn't see that since what is this? I don't know, late July. But yeah, a lot of investors were piling short. They got caught. Kathy Woods, even Kathy Woods' ARC had its best week on record. Can you believe
Hmm.
that? Best week on record, rising nearly 19%. Speculated tech stocks got a boost as traders been reducing. Wow. Fast money quants. This is the problem. Like those I would say AI quants. They had a 302 billion record short bet in bonds, according to Scott Rubner. Oh my gosh. So a lot of
Hmm.
quants got screwed over in this rally. We are in the early innings of the short. What's making me think of this, Wawi? This maybe could be the start of the Santa Claus rally.
Well, it looks like we're gonna have an early Christmas
Yeah,
based on what happened. A short
oh,
squeeze
true. Or maybe it's
apparently
too early.
happened.
Yeah, maybe it's still too early to say. There's Thanksgiving, but we'll see. Systematic demand, yeah, short covering definitely. He estimates the quants may step up around 105 billion in bonds over the next 4 weeks next month if prices remain unchanged, and as much as 456 billion if this week's advance continues. The short positioning of the CTAs in stocks could also lead to an 81 billion S&P futures buying spree. Wow.
Hmm.
So this is quite a turnaround. And just a couple of days ago, a lot of people are in the bearish side of things. They got caught pretty bad on this turbulent rally to the upside. So another article from Bloomberg's S&P has best week in 2023. US hiring cools, like what me and Wawi have identified. Unemployment rate, yeah, I think we already discussed this. Yeah. So, like you said, Wawi, Treasury yields tumble on dovish Fed bets, indicating rise in bond prices. So people are buying actually everything at this point, recovering. So Bank of America warns fear just as costly as greed. Says buy US stocks, according to
Hmm.
Bank of America. Hartnett, he's a well-known technical analyst in Bank of America. Technical factors no longer impede equity gains. Submarinian, another analyst in Bank of America, well known. I think he usually gets interviewed in Bloomberg too. Better entry point for S&P 500 now than July. Two of Bank of America's leading market strategists struck a rare agreeable tone on Friday, each prophesizing gains ahead for equities, at least in the near term. So extreme fear can be just as costly as greed. So looks like they're turning a little bit bullish until at least for the near term. Uh, okay, according to this chart, S&P is testing a downtrend channel, although it's kind of poised to break out. Look at that channel right there. It's trying to break
Hmm.
out. And that's timely because the 125-day moving average is about to get pierced. Unless there's like a bad news, or I don't know. If there's enough good news in fundamentals, then maybe stock market would retreat. Right now it's like very inverse, right? Well, it's kind of confusing, but
Yeah,
yeah.
the traders especially have been, profit taking every time they have a chance. But I found out this past 2 days there's not a lot of profit taking
Mhm.
as it used to. So I think they're trusting that the Fed is not going to increase any more rates. So pushing that, that tailwind for
Yep.
the equity markets to go up. But
Yep.
things can change, you know. Nowadays, you just don't know what news is gonna come up that's gonna cause some volatility.
Right. Looks like, yeah, but right now market is cheering. And this is the strategist contrarian indicator. Bloomberg shared it here. If you're going to look at the chart, a lot of investors, like what we've talked about, are bearish. And this was a better entry now compared to back in July when there was a sell-off. So, yeah, a lot of bullish sentiment coming from experts. Now let's take a look at where the money was flowing before the rally. So this was just published this morning. Global money market funds attract robust inflows on central bank policy caution. So investors channeled a lot of money into money market leading to November 1st. So this is before the rally for the past couple of days. 65 billion went into money market, their biggest weekly net purchase since March of 2022. So
Mm.
a lot of money going into the safe haven bets. So I think the interest rate, just parking your money, still weighs, for these group of investors. Mm, US, Europe, and Asia. Money market. Okay, so money market in those countries drew a lot of inflows. Okay, global equity funds also drew $1.8 billion, their first weekly inflow in 7 weeks in the past 2 months. So those people who put their money, surge in demand in Asia
Yeah,
for
because it's
2.6
cooling
billion.
down here in the US
Mhm.
and
They,
Europe.
yeah, they poured a lot of money in Asia, the most in 4 weeks. Sectoral equity funds. So still witness a lot of outflows. 4 billion, the highest of the four. Financials. Healthcare and tech lost 1.6 billion. Okay. So tech is still not favorable? Oh no. Global bond funds experience outflows as well.
Yeah, tech
Interesting.
could be overpriced right now
Ah, that's
because
true.
with the communication sector, it's been up this year.
Yeah, they've
Like,
been winning. That's true. Yeah, I forgot to pull up the group performance here. Wow, everybody is in the green for the past week. Real estate is number one.
wow.
Consumer cyclical, financials, banks. I actually saw a publication from CNBC. I think I have it here on the side. Bill Gross, bond manager, bond fund, is now advocating and buying bank stocks. He has 3 bank stocks that he had shared that he's been willingly buying because they're under book value, like Benjamin Graham, Warren Buffett classic approach. Energy, meanwhile, is the worst. Well, not worst, but they're still positive, but the least positive among the entire group for the
Well,
past.
for our listeners, what are those three banks that he
Mhm.
is investing in?
Yeah, we have that pulled up here, I think.
For myself, I have JP Morgan and Bank of America.
Oh, there we go. It's a Bloomberg who published it. Bill Gross is buying regional banks. They says they've
Mm,
hit bottom.
it
So
makes
this was just
sense.
published yesterday. He said he believes regional bank falling knife has hit bottom. The co-founder, chief investment officer of Pacific Investment Management, is buying Truist Financial,
Hmm.
Citizens Financial, Key Corp, and First Horizon Corp. So I'm buying, this is what he tweeted yesterday. TFC, CFGs, Key, FHN. Oh,
Hmm. Well,
uh,
TFC's been doing good. It's on my portfolio for the members of the group.
yeah.
Um, I've been a net buyer this past 3 months, thinking that things would change for the better at the end of the year, and looks like we're just seeing the tip of that change. But again, there's still some geopolitical risk that can happen.
True. Still, there's plenty of risk. And on this tweet alone, it's full of information because he is also saying is the best strategy is to invest in the yield curve itself, that it will disinvert, like continue to disinvert, such as buying twos, short duration, and selling tens. So it should go. He's saying that the yield curve will uninvert over the next 6 months.
Wow, quite
So
the.
that's a big call right there. And if we're gonna take a look at the 2 year and 10 year spread, for the past year, yes, it definitely has been going up, less negative in the last couple of months since July at least. So that's one thing to watch out for. But since recently, past 5 days, it's actually I think been going down. Look, it's been going down actually. Past 5 days. That's why the market is celebrating, I think. We have been observing this past couple of recordings. As the 10 and 2 year goes down, the market rallies. As it goes negative, further negative, the market rallies. But as it was zooming up, the market doesn't like that. The market goes down. So regardless, he's bullish in those banks. He's saying that waiting to own some of them at 60% book value and 7% yields. He said he saw a recession in the fourth quarter. Yeah. So he's still open to having a recession, but he's definitely bullish on banks. 30-year mortgage too is falling off the cliff. The cliff.
Well, that's a good sign, Mark. It's
Mm-hmm.
been ratcheting up so fast, and to
Yeah.
see it go down, that's also a good thing to see.
Yeah. From 7.92, even 8% back in October 18th.
Yeah, it hit that top of 8% at one point,
Yeah.
and
Now
now
we're
we're below 7.5.
7.38. So that's a
I
big dip.
I think once it's hit around 6%, you'll see a boost in sales
Oh yeah,
of homes.
more
So
likely.
so just waiting for that to happen, and that surely would be another strong signal for the whole market,
Mm,
especially the financial sector.
yes. It just depends on the reception of the consumers at this point, for sure. Less interest rates, the lower the interest rates, the better deal that they can get. So JP Morgan, this is like published 3 days, 4 days ago. JP Morgan remains negative on the market, along with Morgan Stanley. So Kolanovich is saying Wall Street estimates for earnings per share growth should be revised lower because it's divorced from reality, from risk. So he is warning. He is saying that absent preemptive rate cuts by global central banks, we see a risk compounding with peak effect of restrictive monetary policy still ahead. So he is just warning that when the Federal Reserve and other central banks fail to cut rates, then it'll be tough for a lot of companies to operate in the at least for the fourth quarter. Well, it didn't say any specific timeline, but it'll be restrictive for companies to operate. Also, Mike Wilson of Morgan Stanley said profit expectations were too high for this fourth quarter in 2024, even in an economy that's performing well. So those two, a lot of professional investors, fund managers follow their advice. So this is Morgan Stanley, Mike Wilson. He's a little bit more pessimistic since last year. I'm trying to find it's a lengthy one. From our perspective, it says it appears that 2023 is coming full circle, with markets worrying again about the impact that higher interest rates will have on growth rather than just valuations. The delayed impact and reaction on the economy is normal, but once it starts, it's hard to reverse.
Mm-hmm.
While we were early and wrong, so he admits he's wrong, in calling for this outcome in the spring, we think it's now upon us. For equity investors, what that really means is that this year is unlikely to see the typical fourth quarter rally. So he's not going for the Santa Claus rally, Wawi.
I know because the Fed is still on their stance of keeping the rates high. So, but we're not gonna give up on the Santa rally until
Yeah.
December
Woo-hoo.
Fed meeting. You never
Still
know
bullish. Yeah.
what
We
they're
got the
gonna
bulls.
announce.
We got the bulls on our side.
But
So
definitely, be good to keep some money on the money market side, you
true,
know,
true.
just in case something
Dry powder.
happens.
Yeah.
Yeah, get some dry powder and wait for the wave to come up if the Fed starts reversing.
So yeah, on this episode right now, if you're still listening, you have those great advices from, leading market analysts, technicians in the whole world employed by Bank of America Merrill Lynch, which says that it's a good time to buy right now. That's Bank of America. And then you have the two big banks, Morgan Stanley and JP Morgan, saying that it's actually divorced from reality. So quite a contrasting view, but here we are, to discuss, we try to dissect numbers and stuff. So with our little amount of time, we're gonna dive into the earnings report that just came out from the earnings summary from FactSet, at least as of today. So at the end, looks like let's see what the numbers are. 81% have already reported in the S&P 500. 82 of those companies that have reported have earnings per share above estimates. So it's been a strong earnings season,
Hmm.
above the 5-year average of 77% and above the 10-year average. If the 82%, according to FactSet, is the final number, this will mark the highest percentage of S&P 500 companies reporting positive earnings per share surprise since third quarter of 2021. So a lot of upside. I don't know what the two banks are talking about about this saying that
Well, well, that upside is on the cost of layoffs,
mhm,
of thousands of workers layoffs, and pricing passed down to consumers. So that's what they're talking about. You
mhm,
can't, you know,
yeah,
keep doing it like that. You can't keep laying off your workers
that's true.
so you can
But
satisfy your stakeholders.
yeah, but like what you said, the UAW, one of the largest, worker unions out there, have now settled with Detroit, Detroit, what
Big
do you call
three.
those? The big three, yeah. So maybe, may just maybe, this might indicate the strong bounce in the fourth quarter now that everybody's back to work and working the grind.
I'm seeing, that would be boosted,
Yeah,
by a big tailwind if the
big tailwind.
Fed, yeah, if the Fed Reserve will, kind of hint on when they're gonna ease ease on the tightening.
You know what? I feel like maybe those two banks that we have discussed that are negative, they have a lot of short going into this, going into this month. Their quants were on the negative side of things, and they're being crushed right now because of the rally, the short covering, which is painful if they're all short. I don't know. So yeah, it's one
Yeah,
of
we
the
really
best
don't know what's
quarter.
going on, behind closed doors, but
Yeah,
that's likely.
earnings. Yeah, earnings this third quarter, unbelievably, is the best
Hmm.
since third quarter of 2021 when we were just reopening things up, airlines and all that.
Yeah, we've seen an increase in productivity considering some of the layoffs we've had, which is absolutely amazing, how strong the economy is on the background of this high interest rate.
Yeah, 8 of the 11 sectors reported year-over-year earnings growth. Three sectors that reported decline: energy, healthcare, and materials. And then sales revenue, 62% of the S&P that have reported are above estimates too, which is which is below the 5-year average of 68 and below the 10-year average of 64. So that's a slowdown right there in terms of
But
sales, which is the top line, which is, if you're able to continue to raise your prices and there's demand, it should still be somehow positive. But right now it's just 62%. So a
mhm,
lot of these companies are just squeezing in more profits, like what you said, Wawi, cutting layoffs
mhm,
and downsizing to improve their profits. So I think that's what they should be pointing out, JP Morgan and Morgan Stanley, but instead they're referring to earnings that needs to be revised. I think it's not earnings that need to revise, the revenue. Because Wall Street is really focused on earnings. Maybe that's why they want to bring that topic up.
mhm.
I'm in particular of the revenue because if there's no revenue, it's hard to keep laying, like what you said, while we keep laying off people. In the end, there's only so much employees that you can go with to
Yeah. And
do the
so much
strategy.
pricing you can pass on to customers and consumers.
Exactly.
So likely an easing is, because if they continue with this long interest rate, eventually you can't keep raising your prices. You're gonna hit a limit, and
True.
unless that's the goal of the Fed is to make the market crash,
True. Which is,
is to have a
hard landing. But I think
which
they're
is
on the
gonna be
soft
a
landing
hard
camp right
landing.
now. Yeah. So for the forward 12-month PE ratio for the S&P, it's 17.8, which is below the 5-year average, 18.7, but still above the 10-year average of 17.5. So we're still a little bit at the fair value range, that's I would say.
Hmm.
So we got a little bit like less than 5 minutes left, and we're just gonna probably try to hit the big tech, the
Hmm.
reports. Oh, just look at the numbers, see if we're just gonna take a look if their revenue went up and if their profits improve. So Apple actually, for those who are closely following, this is the fourth consecutive quarter that they have reported decline in revenue. So they actually met expectations, but their forecasts weren't that as impressive. That's why its stock went down. Yeah, yesterday it was down. Well, I'm not sure. Yeah, it went down 3% yesterday, and now it recovered. So it's down just 1% since it reported disappointing outlook for the fourth quarter. I can't seem to pull up their numbers as we are running out of time here. Here we go. So
Hmm.
PDF. All right. I don't know. Maybe consolidated revenue. Uh-oh. I think we can pull it up on time, but yeah, for 2022 they have 394 billion. This year it's 383. So net sales have declined about 11 billion, and profits also declined by almost 2 billion. So decline on both for Apple. Not a good performance for the whole fiscal year. So they just ended their fiscal year. So for Google, here we go. We're gonna do it quick. Google also declined. Oh no, wait. This is 2022, this is 2020. Okay, Google revenue increased by 1.7 billion. So Google is 1.7 billion increase in revenue. Profit decline for Google from 16.4 to 15 billion. So that's
Higher
drop.
cost and expenses, looks like.
Yeah. And you would expect, right? They should be the ones who are good with this kind of things, squeezing profits, because they've been laying off a lot of employees. So next would be Microsoft. I don't know. It's not opening.
That'll
Amazon,
be
well. So Amazon, here we go. Let's just look at the numbers quick. Oh man. Okay, here we go. So for Amazon, profits or sales improve as well.
wow.
Strong improvement. $40 billion more
Golly,
for the 9
strong.
months. Yeah, for the quarter alone, it's like 20 billion almost. Profit wise, yep, negative 3 billion last year, almost 20 billion this year. Very strong
Wow.
for Amazon.
Surprise.
All right, so we got last one here. Microsoft. So Microsoft, another giant. Revenue, it improved. 6.4 billion increase in revenue. Amazing. Profit improved by 5 billion. Okay, so I guess we got less than a minute to go, Wawi.
I guess Google is just somewhat behind on their AI thing.
True.
What do you think?
Yeah, more likely. Well, I guess we're gonna cut it short at this point in time. Thank you guys for tuning in. And again, this is Mark Yu signing
Wawi
out.
Santos signing out. Natapos.